Uh, Good evening to each and every participants over here. We welcome you on this session of transfer pricing, very delinquent topic, and it has its own significance. And considering the globalization, considering the cross-border activities, this transfer pricing is one of the most important topics which is there and which has to be. And I believe no tax practitioner can be aloof without this transfer pricing. Everybody has to be aware of the transfer pricing. Maybe he is or he is not into international taxation. Today we have a very brilliant faculty with us, Akshay ji, who is having a wide firm and whose formal introduction will be given by Tanvi Pradhan. Before I formally request Tanvi to introduce the speaker, I would request our chairman WRC, CA Ketan Sayar, to kindly guide on the session.
We will play ICI Moto song. May I request backend team to play ICI Moto song?
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you so much, backend team. With this, let me welcome all the participants to this fantastic session on transfer pricing. And we have learned faculty Akshay Kenkre with us. Thank you, Akshay. On behalf of Western India Regional Council, I place on record sincere thanks to you for your sharing your valuable knowledge and spending your time with WIRC. This session will be recorded and we'll be uploading it on a YouTube. Also, I recognize and thanks Tanvi as well as Chintan for putting their efforts and spending time for this DTSC series which is going on. Vice Chairman Direct Tax Jayesh Bhai is working in the capacity of Direct Tax Committee Vice Chairman. Also is working as a Banking Committee Chairman. Thank you, Jayesh Bhai, for all efforts being put. He is having wonderfully designed one program on this Saturday. I'll request Jayesh Bhai to brief about that as well to the members on international tax for the international tax lovers and transfer pricing practicing members. Let me announce that on 10th, 11th, 12th, we are having a international tax transfer pricing FEMA RRC happening at Jaipur, COE, Center of Excellence. So requesting members to take advantage of that and enroll for the same. On 19th and 20th of December, we have the regional conference happening at World Convention Center, GEO, Mumbai BKC. So today also at the early bird discounted fees of 4,500, the registrations is happening. Requesting all of you to take advantage and register yourself for the regional conference, the biggest program of WIRC, to be attended by almost 2,000 chartered accountants. With this, once again, welcoming to the fantastic session on transfer pricing. Since the learned speaker is there, I will not mention about the issues in transfer pricing, but it is going to be very, very interesting. We are, having a season ahead of transfer pricing, be it domestic transfer pricing, be it international transfer pricing. I think way the changes have happened in a couple of years, it has become very, very interesting. With this, thanking once again all of you for joining the DTSC, joining today's session. Thank you. Over to you, Jayesh Bhai.
Thank you, Chairman sir. Thank you for your enlightening words and words of wisdom and the activities which are planned for future. The activity which you have mentioned about the forensic course on this Saturday, the session encompasses various issues in forensic audit, how to get the forensic audit done, what are the key factors, how to identify red flags, and various topics are there. Full day seminar is there with all learned speaker coming over there. So I request if all the participants over here to do the join the program. This is a physical program which is kept at BKC WIRC. So anybody who wishes to attend can definitely register the course and they can attend the program. So, and Tanvi ji and Chintan bhai, thank you for coordinating this session. And yeah, it's really pleasure to see the youngsters taking active participation in all the WRC activities. So I'll request Tanvi to kindly formally introduce our today's dynamic speaker, C. Akshay Kenkre.
Thank you. Thank you so much, Jaisha. Thank you so much, Ketan sir. Good evening, everyone. I'm Tanvi Pradhan. It is my absolute pleasure to introduce you, our distinguished speaker for today's session, CA Akshay Kenkre. Akshay sir is a highly skilled and globally respected expert in transfer pricing and international tax advisory. With deep technical knowledge in cross-border taxes and international transactions, he has earned a reputation for delivering practical, effective solutions in an always evolving business landscape. Akshay's contribution is highly recognized, and he was recognized as a highly regarded practitioner in 2025 by the International Tax Review and was awarded the Transfer Pricing Advisor for the Year in 2023. He His efforts to put India on the map is truly exceptional by building one of the most finest professionals in this space proudly, which is made in India. Today, we are fortunate to hear from someone who is such an distinguished speaker. So please join me in welcoming CA Akshay Kenkre. And sir, we value your expertise in transfer pricing, the challenges that are faced, and solutions for the same. So please, we welcome you all.
Thank you, Tanvi, for a very nice and kind introduction. Thank you, Ketan Bhai, for the invite. Thank you, the entire committee, for arranging this. Jayesh Bhai, thank you. And I hope I'll be able to make some meaningful impact today in this DTC course. What I'll do is I'll just share the screen. Uh, just tell me if you're able to see this.
Yes, sir.
Yes, we can see.
Great. So transfer pricing, as we know, very integral part of any income taxes, not only in India, at a global level. And India transfer pricing is just more than a teenager. It's just become an adult a few years back because it's only 24 to 25 years that it is existing in the country. But today, the voice that India shares in the transfer pricing arena is extremely significant at a global level. Uh, Proud in that sense, where I see a lot of transfer pricing service centers also being set up in India, which are acting as a back office for the globe. So a very evolved topic now and very advanced analysis is what uh, we are looking at when it comes to India playing a role in transfer pricing. Now, while you are going through the entire direct tax course, uh, till now, whatever you have learned and whatever you will be learning even after today is all going to be more rule based because it's either allowance or it is disallowance. If you are an employee, you are getting a salary. If you are a professional, you are getting professional fees. So it's very, very rule based. It's very different when it comes to transfer pricing because transfer pricing, as such, at a global level, is not a rule based law similar to also general anti-avoidance regulations. It's a very, very principle-based regulations, which means that you could have multiple interpretation for the same problem in hand. And that's the reason why it makes the tax law a little bit more hard to interpret because it's not the law that we are interpreting, it's the business situation that we are interpreting and try to relate it to the tax regulation of that particular country. So As such, we have to remember that every time that we are looking at transfer pricing, we are talking business. And even what we are going to learn today are topics which are very close to business economics and not so much taxes. The impact of that is going to be taxes. Uh, Till 2017, transfer pricing was predominantly the only anti-avoidance law in the country before the advent of GAR. As and when GAR came in, TP became more of as a SAR or a specified or special anti-avoidance regulation. But until then, transfer pricing played a very important part in avoiding any type of tax avoidance schemes which are run at a global level, impacting even India. Now, tax avoidance as such is very different than tax planning and evasion. Tax planning is something that the law tells you to do, something like you have a manufacturing tax of 15%, which brings down your effective tax rate significantly if you tick all the boxes. That is called as tax planning. And tax evasion is blatantly not respecting any parts of law. That's tax evasion. Uh, Tax evasion, which also includes black money, ideally is not the biggest devil when it comes to economics. It is the tax avoidance. Because tax avoidance schemes are such schemes where the base substance could be very different and your legal form is very different. So transfer pricing regulation as such tries to balance it out and acts a very important anti-avoidance law in any country to that matter. Now, how did transfer pricing overall develop in our country? It started only in 2001. Not that the law was not there before it, but there were not very detailed regulations as you see in Section 92 existed even then, but you never had 92A, B, C, D. It was only in 2001 that the law was formally introduced. It took almost 5 to 6 years for the country to realize what has hit it. I still remember in 2006, it was the first assessment that we were going through, and the impact was not much. There was confusion in terms of whether only incomes need to be tested or even the expenditure needs to be tested. But then the way how tax authorities have picked this particular topic up, it became almost the first topic ahead of even service tax in terms of tax litigation at that point of time. Until 2013, it reached a peak. Uh, After 2013, the country overall, from a transfer pricing standpoint, has matured. BEPS regulations or maybe the plans were also uh, uh, they were placed in. India became one of the top forerunners in terms of adopting most of the BEPS action plans, and you could see most of the tax avoidance matters uh, are undergoing and having some type of a resolution after that. Now the focus of transfer pricing has again changed after 2020. We are talking of APAs a lot. More and more taxpayers are going for safe harbors. Somewhere we are trying to go towards the ease of doing business. And of course, everybody wants to be above that 15% to avoid the pillar two, although India has not formally adopted it. From the challenges standpoint, because that's going to be the topic of today, uh, there are certain transactions which are international transactions which have been one of the focus from the tax authority standpoint, and those are marketing intangibles, there are corporate guarantees, very important are management charges, many intellectual property and royalty oriented charges. So these are various type of transactions which came under the limelight, and even today they pose challenges in terms of functioning for any multinational company in India. The way how we will develop our discussion today, and although it looks like a monologue, I would still like to have a discussion with you because there is a question answer session. If you have any questions, please feel free to add in the chat box. I'll be more than happy to address it at the relevant point of time or at the end. But the way we will take the session ahead today is we'll start with basics. I'll be a little bit more fast today than in general, because to sum up transfer pricing in 2 hours, it's a Herculean task. But I'll not try to miss anything. But let's go through the basics. Let's look at the practical aspects of it, and then let's look at certain practical challenges and solutions in the transfer pricing arena as of today. So this has been typically the litigation journey in India for transfer pricing. The orange color boxes are the number of cases that have got selected, and the gray color bars are basically the high-pitched adjustments that has been made since 2006 to 2015. This is the data that is available with us, which proves that in 2013 and 14, the adjustment went up to 70,000 crores in transfer pricing on multinationals itself. Post that, as I said, lot has settled down. Uh, there has been risk-oriented scrutinies which are placed now, something called as a computer-assessed scrutiny, where transfer pricing becomes one of the risk areas, and the reason is also provided very clearly. Typically, if you look at the general transfer pricing world, on one side you have the transfer pricing law, which you need to follow. But what happens in practice is very different because the transfer pricing documentation or the study or the planning analysis, these all do not find mention in the law. Law gives you certain points to cover, but it does not give you formats. It does not tell you for a particular transaction what you need to do. It also does not tell you for which transaction you should apply which method. There is a concept of most appropriate method. That's also not the most correct method. It's a just the appropriate method because the law also recognizes that business circumstances and conditions cannot be written in a rule format. So you have a lot of transfer pricing documentation to do. That's one part of transfer pricing. uh, there is fair bit of comparability analysis because at the end, all we are doing is comparing one company to other set of companies to either find the profitabilities or to find the prices of it. So ultimately, it's the profit that you are looking at or the price which leads to profit that needs to be at arm's length price, and that's the reason why we do a lot of comparability analysis. As professionals, our responsibility is also to undertake transfer pricing audit, similar to what statutory audit is, similar to what tax audit is. They generally call it as a certification under transfer pricing or under Section 92. Uh, but ideally, it's a full-fledged audit. The institute has also released a guidance note which has been updated on transfer pricing audit. So the way how you have even GST audits or the way you have your stat audits or the tax audits, TP audits form a very important and integral part of a professional journey. It's just not a certificate that you have to sign and close. There are many conditions that you need to fulfill in there. Let's quickly get into the basics of it. What is the transfer pricing? Whenever there are two associated enterprises or related parties in general terms, they transact with each other. This could be either cross-country or this could also act as a specified domestic transaction where there is a potential of either eroding a base or shifting of profits. Base erosion happens when you have assets and this asset gets shifted from one country to another. Generally, these are intellectual property. So either you have erosion of those assets or you have the erosion or shifting of profits or profit-making capabilities in future. That is when transfer pricing comes in because whatever transfer happens in whichever circumstances, that should be at arm's length price. There should not be any control or influence of other company into say an Indian company while doing a particular transaction, and that should happen in an independent circumstances. That's the reason why transfer pricing law was introduced. And if somebody asks me, I will straight away say that it is to avoid any type of base erosion and profit shifting. And that's where BEPS as a terminology comes in, which has been also the project of OECD. Why transfer pricing? Although theoretically it's important to know, it protects the tax base of a country. It leads to equal tax sharing between the countries altogether, either the residence country or the source country or more than that. And of course, it avoids any type of discriminations between how a multinational could function and how a local company would function. And that's only when there would be parity and there would not be any added advantage to multinational companies to function in a country with certain objectives. Uh, Professional and company reason to focus on transfer pricing is, first of all, everybody, including the investors, the board, the management, is looking at bringing in certainty in doing global businesses. If you tick the right boxes at the global level, you will get that certainty. And the most important box there is transfer pricing. Be mindful that it's not only your country that is undertaking or has a transfer pricing regulation, but it's also the other countries. So if there's a transaction between, say, US and India, both these countries have transfer pricing regulations which are broadly similar in terms of principle. Because transfer pricing is compliance, it's important that you do comply and avoid any type of penalties. uh, Transfer pricing also acts as a very successful planning tool at a global level. If you are able to align your value proposition to the profitabilities that you are bringing in, then you can look at optimizing your global effective tax rate for your multinational group. So it acts as a planning tool. In a bracket, I'm again saying it's not an avoidance tool, but you can basically tune this to plan your business and your client's business in such a way that they are effective and they're not bleeding in taxes. And of course, it makes your supply chain or value chain uh, very, very efficient. And any type of reorganizations that you want to bring in, transfer pricing could be a big boon to you. Now, this is a very snapshot of the transfer pricing law that we have because it is one of the most tiniest law in the direct tax law. But I think the thickest book that I have ever seen, which runs into 4 to 5 volumes, is on transfer pricing, which is on this law. So to sum it up, you have only section 92 and some subsections of it, which is section 92A, B, or maybe variations of that section till F as your transfer pricing law, plus section 286, which has been a recent introduction after BEPS, which includes and which is a part of transfer pricing. But then you have rules around transfer pricing, which is your 10 ABCs and the further variations of it. But in essence, the law is thin, the interpretation and the applicability is extremely wide. So we are going to focus on most of these sections today, and then we will develop it further. If I want to simplify transfer pricing in a nutshell, I would say your section 92 sums it up very effectively. It says any income, which is defined in section 2, subsection 24, arising between to your associated enterprise from an international transaction shall be computed having regard to an arm's length price. Now, this definition itself says that we need to study what an associated enterprise is, what an international transaction is, and what an arm's length price or ALP is. Very important thing for everybody to note here is that in the new income tax bill, which has now become an act, this definition per se remains the same. I think that is in section 161 of the new Income Tax Act 2025. But what has changed is instead of word computed, they have written the word determined. Okay, I was just checking for some questions. They have changed the word computed to determined. Now, it has a very wide ramification because even today, when you sit before the transfer pricing officers, one of the biggest appeal to say is your responsibility is to compute the income. Transfer pricing is not a charging section, it's only a computational section. While my view has always been that it is not only a computational section, it also has charging powers. But every time that was shot down by the legal interpretation of shall be computed, which has now got changed to shall be determined. So, which means transfer pricing gets its power now in the new Income Tax Act. Although we say and we see that it's not major change, it's basically you're trying to refine the language. but there is going to be a legislative intent behind the computed and changing it to determined in future. Okay. Moving over to arm's length price. Typically, an arm's length price is generally a price which is between two independent enterprises. We do not want a situation where we are looking at any control transactions. So whenever we are also doing any type of searches, we always focus on transactions which are independent in nature and which are entered in similar market circumstances. Let's take a very quick example of this. If you are selling, say, a Bisleri or Aquafina in a normal market at 20 rupees, sometimes you see same variations of it being sold in multiplexes at 50 or 70 and 100 rupees. Although the product is same, it's drinking water or mineral water, the prices are different because they do not correspond to open market conditions. In the multiplexes, the conditions are very different than your market conditions, and that's why you cannot compare it. So whenever you are going to compare your transaction or your client's transactions with any comparable companies, those need to be independent and that should correspond to similar market conditions. Only then you can compare it, and that will fulfill the definition of arm's length price. Generally, people use ALP and fair market value interchangeably, but ideally these two are not same. Fair market value as a concept has also been used in the income tax law at many places, but ALP somewhere overrides the fair market value because it gives certain type of methodologies and certain scientific methods to determine an ALP, and that ALP is determined by the 5+1 method. And FMV ideally does not have any method to follow. It could be simple transactions that you need to compare and not even document that could be considered as a fair market value uh, transaction. Uh, as far as conduct is concerned, for ALP, you actually need the transactions to be entered into. While for fair market value, even a quotation will work. So whenever you're talking to transfer or on transfer pricing, it is the actual transaction which is very important and not the future transactions or quoted transactions. So it's pretty scientific. It's only after you applying those methods you can come to ALP, and you cannot just look at any fair market value and adopt it as ALP without unless you have a very strong proof around it. Let's look at certain approaches to ALP, because now we know that uh, arm's length price need to be determined through those 6 methods that we have, the last method being any other method. Uh, Two broad approaches were discussed at a global level. OECD themselves said that transfer pricing sometimes could be very tricky and very dynamic and subjective. And why not we have something which is more mathematical in nature? And that's why they came out with a formulary approach for the entire supply chain or value chain of a multinational company. They said, let's have a formula of what is the percentage profitabilities every country will make basis the transaction that is entered into. But a formulary approach, although it looks like very easy approach, it does not take into consideration the actual business circumstances and economic circumstances, which are very important under a transfer pricing regulation. Now, let's take an example again in this case, that whatever are the business circumstances in US are not the same business circumstances in India. And that's why any type of profitabilities, if you try and give to India on a formulary approach, may not be justified in terms of its fairness. But still, now that transfer pricing is there, we have spoken about pillar two, which is global minimum taxes. Global minimum taxes follows a formulary approach where they say at every jurisdiction by jurisdiction level, there needs to be a minimum tax of 15%. And if that tax of 15% is not there, then the other jurisdiction has the right to tax the differential amount unless the local jurisdiction have something called as a domestic minimum taxes. So this is a formulary approach which is now coming into place, but this is what is being placed over and above transfer pricing and not as an alternate to transfer pricing, which I feel is a fair option to have for a particular purpose. Moving on from an ALP approach into associated enterprises, AEs are again it's a very important definition for us to understand because it talks about the concept of MCC, which is management, control, and capital. Now, there are various judicial precedents around the concept of MCC, and that's been going around since I think the law was in 1921 till today, and it's not very clearly defined. And while the lawmakers were making this regulation of transfer pricing in early 2000s, they have realized that if they just say management, control, and capital, there would be interpretational issues. That's why they made this particular definition of associated enterprises very, very specific in nature. Let's go through the definition. It actually means a direct or indirect participation, right? At any point during the year, which means even if one company is folding into another company for one day and say that is 31st of March 2025, then the transactions entered between both these companies, and I'm saying hold, which means maybe 100% held. The transactions between these two companies will have to be tested for transfer pricing for the entire year because the concept is at any point of time during the year. There are positions taken by certain consulting firms that only after you become an associated enterprise, the transaction will be tested for. Some firm says that you need to test it for the entire year, even if you're holding it for one day. So again, this is an interpretational issue. It has to achieve finality, not that there are many judicial precedents around it. But I feel the righter interpretation around this is that even if you're holding it for one day, for the entire year, the transaction needs to be looked into because 92A is very different than 92B and both are for purpose of each other. So that's how they are reading in terms of definition. So what do you mean by direct or indirect participation? It means if say A is holding into B 50% and B is holding into C, say 30%. The company law, in company law interpretation, you will do 50% of 30, but that's not how you will do in transfer pricing. You will say B is holding in C 30%, there is a significant influence, and A is holding in B 50%, then again it is a significant influence, then A is a related party of C. That is how a direct and indirect participation in transfer pricing works. So it's not going to be a multiplication formula. It's a very simple question that you need to ask whether there is a significant influence, which is about 26% between one company to another company. If the answer is yes, then that could be direct or indirect participation in the other company. So this could be between your holding and subsidiary, or maybe parent and subsidiary, or a vertical relation, or even a horizontal relation of sister concerns, where you share a common parent or where you share a company which has significant influence in you, which is about 26%. Are there any questions still here? Because if there are, I'll be more than happy to answer them so that there is clarity going forward. Okay. I mentioned that under the Indian transfer pricing regulations, management, control, and capital were not let out loosely. They were specifically bundled into 13 conditions. So you have section 92A subsection 1 and section 92A subsection 2. The way how it reads it and even the way how 3CB is structured is you will be an associated enterprise if you are going to fall into section 92A2, which further elaborates into 13 conditions, which are summarized here. I'm not going to get into all 13 conditions. Uh, But there is going to be a twist here in the new income tax law where they have introduced 14 conditions. The first condition of Section 92A1 has become the first condition for being a dimming provision in associate enterprise, which means they have widened the gamut of associated enterprise, uh, and they have again brought in the management control capital as the first condition without any percentages and in generality. So the definition of AE has widened. So if you have a management control and capital and your holding is only 20%, even then, because of your significance on the other company, there would be a deeming fiction that the two companies that are there are going to be associate enterprise. This is going to be a very big change, and this is something that professionals and companies should really look into with all their transactions they are entering into. And you need to look at your associated enterprises with fresh lenses and not carry forward the same thing ahead of assessment year 26-27. Few practical tips on how you would want to identify the associated enterprises, because this is always the challenge. Because the first thing that we generally start with is going to be your AS18 schedule or RPT schedule. But after the AS18, we generally get lost in terms of which other companies could fall in the definition of AEs, because AE definition is very specific. AS18 could be a very general accounting definition. So sticking yourself only to the related party schedule could invite trouble, because the Form 3CB that you are looking at and you are certifying, that needs to be true and correct and not true and fair. So the first way how you can really uh, evaluate whether there are any more AEs other than us accounting standard 18 is looking at the manual and automated controls, the way how a company captures a related party transaction or how a company captures related party in itself. Uh, Again, when you're doing a lot of kickoff meetings with the management, discuss with them some certain important suppliers, certain important customers, which they think could fall under the net of related parties, if at all. So do a higher research along with management discussions. We just discussed reporting under AS18, so that's the financial statements that we're talking of, which is the third. Uh, Important, just scan through the list of shareholders. And sometimes you could find shareholders which are private equities, more than 26%, ideally, which is not shown as a related party transaction, but you need to feature them as an associated enterprise for the purpose of transfer pricing. So you might find certain hidden gems like these where you may have to undertake additional analysis than what the statutory auditor has already done. Last but not the least, do contract reviews, because contract reviews can unveil a lot of significant influence of one company into another. Uh, Scan your uh, customer list or debtors list to see which are the top customers, and if you can have the contracts from them to see they are not fitting in something like deemed international transactions. We'll discuss this concept later. Although they don't become a deemed associated enterprise, but they could surely fall in the definition of deemed international transactions. We have any questions around associated enterprises? Okay. Moving on to international transactions. Okay. So we have one question on how passive holdings be treated. Now, if I understand passive holdings from your interpretation, Amlesh, is more like an indirect holding, and I'm assuming this is more than 26%, or in the new law, less than 26%. In such a case, you need to see their shareholder agreement, to be very frank, in terms of the control that they could exercise. So if you have a private equity coming in a place which is not your company, but say your parent company, then please ask for uh, the share transfer agreement or the share issue agreement and read through it, what type of control conditions that they have. And I'm just assuming that they are not having more than 26% in your parent company. Because if they do, then they automatically become your associated enterprises. Yeah, so if they don't have a board seat, if they don't have a management participation, and they are not going to oversee any type of operations in general, if their holding or passive holding is below 26%, ideally they will not qualify because they will not fall in the definition of MCC. Even if they don't qualify, my suggestion would be please document this position as a position paper with yourself or in your transfer pricing documentation while you are evaluating associated enterprises that you have evaluated this and your position is that they are not going to be your associated enterprises. So either it is yes or even no, please document it because ultimately with a TPO, the documentation is going to serve purpose. I'll share certain practical examples with you, but before the TPO, we have also submitted LinkedIn profiles of certain people to prove substance, to prove that a transaction has happened, and that person has a capability of undertaking that transaction. So such type of documentation and depth is something that TPOs do go into nowadays, because it's not just the game of valuations these days, it's also unveiling a lot of substance when we are talking of international transactions. So thanks for that question. It was nicely framed one. Okay, moving on to section 92B, which is international transactions. Uh, Typically, I will keep it very short in this, but any type of transactions that you do between your associated enterprises is going to be your international transactions. The way how the law is defined, it says between two or more A's, either or both of whom are non-residents. They have changed the definition in the new income tax law to say at least one of which is non-resident. Otherwise, most of the international transaction definition remains the same. There has been certain clarificatory amendment in 2012 to further enhance and expand the scope of international transactions to include certain service transactions, guarantee transactions, share transfer transactions, and I think that had a retrospective impact. But now most of them has been brought into the section itself rather than it being a clarificatory amendment or addition. So otherwise, any transaction that you do, which may or may not have any impact on profit, losses, income, asset, liabilities in general, but if you're talking of a separate transaction which is not being introduced or included in the international transaction, just ask yourself a question whether it has an impact of profit, losses, income, asset, and liabilities. Yeah, transactions like corporate guarantees. So just check if do you think that really it's an international transaction, or you can take a position that it is not. The second part of international transaction is, of course, deemed international transactions, where the law has envisaged a triangulation case where to avoid international transaction, and this is very unique to India. It is not very much found at a global level. If you have entered into some understanding with a third party, where uh, such terms and prices are determined in substance by the associated enterprise. Even the transaction between two unrelated third parties and the Indian company will be considered as an international transaction, although both of them are not associated enterprises. So Section 92B, subsection 2, talks about this scenario, and we have seen multiple specified domestic transactions being entered into. Uh, Questions have been whether common transactions on, say, purchase of laptop on a global level or global transactions or global agreements could also fall in the purview of deemed international transaction. That needs to be answered. But again, these are difference in firms that take position. Some say that they need to be, some say they don't. But it depends on the facts and circumstances of the case. Okay. Now, what I have done is I have closed on the law part of it, which is the basic law part of it, which is important for us to go ahead in terms of practicalities and challenges in transfer pricing. Uh, Now, this is a slide where I want to focus on how do we generally make a decision in terms of comparability, right? Now, everybody goes to Starbucks coffee. And of course, we love our homemade filter coffees, but still we pay a very high sum in Starbucks coffee. What could be the reason for that? Because while you are making a decision for paying, say, a 350 rupees to Starbucks coffee, there needs to be some type of rationale in your head. Because when you go to Starbucks, you're not just going there to drink coffee. You are going there for an experience. You are going there for investor meetings. You are going there for working. You are going there for ambience. And possibly that's the reason why you are ready to shell out the 350 rupees for one particular coffee, because you are getting the bundled services which are very intangible in nature. So you cannot compare a Starbucks coffee to a homemade coffee or maybe just a filter coffee in your regular restaurant. Uh, there will be a difference. So every time you make a decision in your head, you're actually trying to work out on a comparability analysis yourself, right? It happens in your jobs. It happens while deciding on a restaurant. It happens while deciding on which type of car to buy. So every time in your head, you are doing some type of or the other comparability analysis, and somewhere OECD has already summarized that what goes on your head, and that's the reason why it has told you that in the transfer pricing domain you always need to look at these five factors of comparability, right? The first factor is the characteristics of property and services. Now, let's stick to the Starbucks definition that Starbucks example that we just discussed about. When you are going to Starbucks, you cannot compare that with a normal coffee because the characteristics of the coffee that you get along with other services is not going to be equal with other coffee. So if at all you need to compare a Starbucks coffee, you may have to look at Blue Tokai coffee or maybe any other bigger coffee brands which offer similar services in addition to just providing you a coffee in terms of for that price, right? So characteristics of that product and service is very essential while you're looking at comparability. Now we are shifting our attention from what is there in the law to what is there in the practical world. Okay. And most of my discussions now will be very practical in nature. The second aspect of comparability that you do in your head is functional analysis. Functional analysis is you compare yourself. Again, I'll stick to the coffee example. It's a function of, say, a Starbucks person writing your name on a coffee mug. That's a separate function. The way they procure the coffees, that's a separate function. The way they are grinding the coffee is a separate function. All of that gets bundled into the product and services that you're getting. You get free Wi-Fi, which you may or may not get in a simple hotel. So you do a proper functional analysis while deciding on whether to drink a normal coffee or whether to go for a Starbucks coffee. Next is your contractual terms. Your contractual terms with, say, Starbucks will be very different than contractual terms with a normal restaurant. Economic circumstances are also important. Uh, if you just want to drink a coffee, you'll never go to Starbucks. Economic doesn't really ask for it. Uh, unless you can really, really afford it. Otherwise, you will always want to extract something additional from Starbucks coffee just than other than the coffee that you are drinking. And last but not the least is from a business point of view, the strategies that are followed. Rather than Starbucks, I would like to give an example of Geo in this case. When they came in with their broadband, they said, your broadband is free for a certain number of months or years. You just give me a deposit or an advance. Now, this was one of the business strategies that was followed by them for attracting a larger mass. And in such case, when you're looking at comparabilities, you need to follow such business strategies. And if there are any differences in business strategies between you and your competitors, appropriate adjustment needs to be made. So these are the five functions or factors of comparability that you need to document. You need to keep in mind while you're doing any type of transfer pricing analysis, uh, in your documentation. Okay. Moving ahead, it's also important to understand what transfer pricing offers in terms of its practice areas. Now, transfer pricing as a compliance, which happens in October, I would say that's only a 2% of the work that generally we do, at least at the firm, and even other transfer pricing firms do. The very important part of a transfer pricing professional's or a firm's journey is the design stage, where a multinational comes to a professional to ask to lay down and to seek advice on the structure that they will follow. We call it the operational structure or a blueprint in the way how the multinational will function in India and how it will contract with companies outside India. That's the first designing or an architectural design that we build as a transfer pricing professional. Uh, it's very akin to, say, drawing holding structures by a tax professionals. Uh, so this is typically uh, acts as a very solid foundation stone for any multinationals to begin. While Apple started, say, its manufacturing facility in India, the first thing they would have done is to see what type of transfer pricing design they should have while they're going to operate from India, right? So that's the first part of it. Moving on, it's more about the documentation, because once it is designed, year on year, we need to document these aspects in a particular way, which is provided in the law, which is Section 92D. And ultimately, this documentation and design will have to be proven to the tax authorities. Documentation doesn't only mean the transfer pricing study, it also includes, say, the contracts, it also includes any supporting documents to it, it also includes emails around it, and ultimately proving it to the tax authorities, which is defense, which could be proactive or reactive in nature. Proactive defense is you going upfront to the tax authorities and showcasing your transactions for the tax authorities. This could be via advanced pricing mechanisms, or say safe harbor regulations, is what you're declaring to the tax authorities upfront and taking guidance from them. Reactive is you are waiting for the notice from the tax authorities to question your transfer pricing mechanisms and then representing. And if things don't come in your favor, you further go ahead and dispute them and litigate at a higher level if you think you have a solid case on hand. So these are the three pillars on which your transfer pricing is built on for any multinational. Now, while I was talking about planning, if you see, this is typically a roadmap for a transfer pricing journey for any multinational company which is getting set up or which is operating in India or elsewhere. So there are 9 clear boxes that you see here. 6 out of 9, which is 66% or two-thirds, is the planning stage of it. Once you plan your transactions very well, they are going to be compliant year on year. Planning includes, as I said, drawing out a global structure, looking at your value chain analysis, drawing out policies, entering into intercorporate agreements. Now, intercorporate agreements are very different than legal agreements because these are between two associated enterprises. We generally say that these are commercial agreements and these are generally shown to the tax authorities. So it should be in a very fluid and English language and should devoid itself of any legal terminologies which could not be understood by a tax authority. So we can have a separate session on intercorporate agreement, but it's very essential that your intercorporate agreement matches your actual functioning. And that is where transfer pricing policy comes in. So once you have the price setting mechanism, the policies, intercorporate agreement, and the documented value chain, this is where your planning stage gets completed for transfer pricing, based on which your multinationals can start doing certain transactions throughout the year, which are monitored. That's another work that we do. We monitor transfer prices on a quarter to quarter basis so that they are not deviating themselves from the policies that are already set in. This is called as operational transfer pricing. Once that is done, the year is closed, we enter into the phase of contemporaneous documentation. And you need to undertake a search, showcase an example where comparability and comparable transactions have been also entered into that particular year, and ultimately close before 31st of October the Form 3CEB as well as the transfer pricing documentation. And ultimately, after 2 years, the transfer pricing authority sends you a notice, you go and you appear in normal cases. If you are going for an APA, the process is different. So the importance of planning is significantly high. And always remember, this is where you will value add the most to your clients. And the multinationals also take a lot back from you in the planning stage, not so much in the documentation, because documentation becomes more standardized in future. Not that documentation is not value addition, just that it's just a documentation. Any questions still here? Okay. Now let's get into the actual journey of transfer pricing documentation as such. Uh, the most important part to start a documentation is knowing about the company and knowing about the group. Uh, in slang, we called it industry overview or IO. But that is a very essential part to start with any documentation, because that's where uh, you give a good amount of information to the transfer pricing officer in the industry that you work in, because your prices and your profitabilities are going to be determined by the industry that you function in. Let's take an example. If you're looking at automobiles, then it's also the infrastructure aspect of it that you need to cover in your industry overview and analysis. And it should have a bearing on the international transactions. So that type of documentation should be built in. Then moving forward to functional analysis, it is knowing yourself, knowing your value chain, and documenting in a way where it showcases what type of functions you do, what type of functions your group does, what type of function your associated enterprise is doing with relation to that particular transaction. Along with functions, you also add your asset analysis, because intangible assets are extremely important for anybody to realize and to document, because every time intangible assets may not be forming a part of your books of accounts. Its self-generated assets are not recognized in the books, but it has a lot of significance from a transfer pricing standpoint, and you need to mention your assets very clearly to showcase whether you are an asset heavy company or an asset light company, right? And again, last but not the least, in functional analysis, you also need to bring out the risk that you undertake, your associated enterprise undertakes, because the bottom line is higher the risk, higher the return. So if you are going to undertake higher risk between you and your associated enterprise, then you should be getting higher return between both of you. And there are certain risks that we need to test for. And all these function assets and risk should also find a mention in the intercorporate agreements in similar way how it is there in your functional analysis. So that's the first starting part of it. Then you get into the characterization of it, and we'll cover this characterization well in detail in future. Uh, Once you characterize, you select which party you want to test for. So if I have this pen and I want to sell this pen and I am a seller, so either you can test me or you can test the purchaser. Uh, the perspectives will differ. From one perspective, it is going to be a purchase perspective. From my perspective, it is going to be sales perspective. But ultimately, we are going to test the value of this pen. So any perspective that you look into, if it is at arm's length for a seller, it has to be an arm's length for the purchaser. That's a basic assumption. So either you can do one-sided transfer pricing analysis or you can do two-sided transfer pricing analysis. Two-sided transfer pricing analysis is only and generally undertaken when there are more than one IP scattered between the associated enterprises. If the IPs are concentrated with one associated enterprise, generally you do one-sided analysis. After that selection of method, uh, you have to evaluate the method and select which is going to be the most appropriate method for you, and then uh, reach at the conclusion whether it is going to be at arm's length or not. This has to be repeated for transaction by transaction. When I say transaction, it is class of transactions which can be grouped together and analyzed together. So that is something that we have to analyze in the function analysis part of it. So this is going to be your journey that you need to follow for your transfer pricing analysis in the documentation. Now, when we spoke about FAR or functional analysis, generally the length and breadth of that will depend upon what you're really wanting to achieve. If it's going to be a simple policy document, you can have a short FAR, but if you're going to submit it to advanced pricing authorities, then APAs, then you need to basically have a much detailed and thorough FAR, which is close to the ground because they do a lot of digging through, and they do question on the FAR aspect of it, because ultimately your returns is linked to the functions that you undertake to. Now, this is a very short snapshot of a general supply chain analysis or FAR that we undertake. I have given on the right-hand side uh, manufacturing as an example, but you can take this slide as a mother slide for drafting FAR for any type of product or service, because a FAR is always two-sided and it is not one-sided. So for everything, you will look at who is doing the research and development, right? Uh, Either it is you or it is your associate enterprise, and you will detail that out. Then even in service and even your products, you will definitely have a procurement function. You may or may not have warehousing function service, but let's talk of manufacturing in this case. In manufacturing, ideally, on the right-hand side, you will talk about equipment procurement, you will talk about their maintenance, you will talk about the process control. Either this is done by you or this is done by your associated enterprise. This is how you will point by point try and give out explanations of the functions that you undertake and your associated enterprise undertake. At the end of it, we will see what type of weights are generally to be assigned for both of these functions, and you will get an idea who is doing a higher function and who is doing a lower function. Now, why we are doing this? Ultimately, to see which is a simpler entity, right? I would not like to test a very complex entity or an entrepreneur, because if I want to test an entrepreneur, I will generally not get comparables. I will get comparables which are a low risk as compared to higher risk. Even if I get comparables for higher risk entities, I may have to do and undertake certain risk adjustments, which I don't want to do because that does not give me certainty in results. So I will generally want to select my simple entities or simpler entities to test them for. And that's where the concept of tested party arises. So we just did a FAR, which are the various steps which I showed you. The outcome of FAR is characterization or categorization. You need to characterize an entity into, say, a high risk manufacturer, a low risk manufacturer, a high risk service provider, maybe a trader with intangibles. This is all business discussions that we are having. Okay, it's nothing to do with stats so much, which will ultimately help you to achieve comparability, because that's how you will zero down on your tested party. I hope all are with me. Okay. So after you undertake the FAR, because you need to select your comparables are generally available in one of these four buckets. So either you are a low or no risk trader, you are a normal risk trader, you're a high risk trader, or you're an entrepreneur trader. So assume that there are, say, 5 comparables for each of these buckets. And so that you categorize yourself well, you need to put yourself or your client into one of these buckets so that we can compare with the other comparables of similar nature. So this is exactly like matchmaking, to be very frank. Uh, I'm giving you certain business model or buckets which are used by transfer pricing professionals but these are generally business terminologies. Whenever you look at manufacturer, there is a concept of contract manufacturer, which means somebody is manufacturing on behalf of you, and you have contracted with that person to manufacture a particular product. Now, a contract manufacturer typically procures a product from you or from open market, uses your processes, converts it, and sells it back to you or the person that you have told to be sold to, right? That's is a limited risk function of just the contract manufacturer. A contract manufacturer would love to have profits assigned and gained on that particular cost that he's incurring. So he will generally do a cost plus markup to you while selling it to you. A toll manufacturer is different than contract manufacturer. A toll manufacturers, they do not take the onus of the goods. The good stays in the name of the entrepreneur. The toll manufacturer is interested in conversion charges. So they will say that for every product that I have converted, I will say I need 1,000 rupees against every conversion, which helps me to cover a per product manufacturing cost and also lives back certain amount of profitabilities with me. So if you are a toll manufacturer, your profitability will be limited. Contract manufacturer, a little bit higher than toll manufacturer because you are buying and selling stuff. Licensed manufacturer will have a higher possibility of making profits or even loss. Here is where you have basically licensed the manufacturing process from somewhere and you are paying royalties against it. And a full-fledged manufacturer will ideally have intellectual properties with himself. And this is the reason I said we should also do asset analysis, because a full-fledged manufacturer can be proven only if it has an IP around things. It may or may not be registered. Similar aspect is then thought through for a distributor or a service provider. Any questions still here? Either I'm being very clear or maybe it's almost like a bouncer. I hope it's the first one. Okay. Yeah, we spoke about the concept of tested party, and tested party is typically uh, a party where you need to test for. And ideally, as I said, between two companies, it's a least complex entity. The other part is just because it's a least complex entity, you don't select it. You also select it for the reliability of data. So you may have another company in Cayman Islands, but you don't have data of Cayman Islands with you, either for the company or for the comparables. So that's not going to really help you, even if it's a least complex entity. So tested party is ideally a party which is either least complex or where the reliable data is made available. The stand taken by the tax authorities is very clear. They would generally prefer Indian companies as tested party. However, that's not the true fact or true principle around transfer pricing. Transfer pricing. APAs are accepting the foreign company as a tested party based on the PAR analysis. Okay, let's run a very short exercise in this case. Uh, the manufacturer A Incorporation has an intellectual property with itself, which is in the US, and the distributor is in India. So distributor will be considered as a tested party in the first case. Similarly, if you have a contract manufacturer, which is B Incorporation in the US, and you have an entrepreneur entity in India, then the US company will be considered as a tested party in this case, although you are doing Indian analysis. Let's talk it more from an IT standpoint. If you are a software product company in the US holding intellectual properties, and India is a service provider or a captive service provider, the Indian company is going to be the tested party. Uh, and if you are a manufacturer company in the US, which is giving you semi-finished goods in India, and ultimately India is giving the finished goods out, then I would consider the manufacturing of the semi-finished goods as a tested party, precisely in all these cases, because we have been able to categorize them all of them as low risk because they are not holding the intellectual property. Now, once I decide on on which company I want to test for, I will ultimately get into the methods that I want to use for testing of transfer prices. Now, I'm using this word testing of transfer prices, but I'll let you know what is going to be, why this only 5 methods or 6 methods. Uh, so the first method is a comparable uncontrolled price method. This is a price-based method. It's an apple-to-apple comparison that we need to do. The resale price method and the cost plus method talks about the gross profit margins. Resale price method is used generally in the distributor's business, which are imports, and cost plus method are used in service provider or export business on the export side in general. TNMM is a very widely used method across, which is transactional net margin method, and this is where the comparability and the benchmarking search comes in. And then you have the profit split method, which is used when there are more than one intellectual property scattered between one or more associated enterprises. Outside this, I think in 2012, there was any other method that was introduced. If none of these 5 methods work for, uh, surely one can rely on any other method, which could include, say, royalty agreements, which are not typically cut, which could also include certain uh, exchange or commodity exchange matrix for prices of gold commodities or say iron and steel. That could be useful to take. So wherever all these 5 methods fails, the 6 methods could be used. A caution is always evaluate the 5 methods. Say that none of them could be applicable for XYZ reasons, which should be 2 reasons. And that's the reason why you are going for uh, any other method and moving ahead with the documentation. Now, typically, if you look at the hierarchy of methods, this is already what I covered, but important part here is cup needs a very high product comparability. So when you say apple to apple, it's not even apple to apple. It's going to be red apple to red apple. And if you say Washington apples to Washington apples purchased at the time of September 2025. So it's going to be that close a comparability. And sometimes it's difficult because it's not a perfect market. It's something that is very dynamic other than the commodities, or if the company itself sells to or purchases from a related party and sells and purchases from unrelated parties, same and similar products, you can use this cup method. Otherwise, most of the other methods are either GP related or OP related. The most popular method is transactional net margin method, where you need functional comparability. So here it's not apple to apple, but you can then compare a fruit seller to another fruit seller. And then you can also add a vegetable seller to it. So it's that level of functional comparability becomes important and your products lose significance there. Now, all these methods that you use, I told you these are price testing method, but same methods can also be used for setting prices, which is before you enter into an international transaction. This is the planning stage on the left and the testing stage on the right. So ideally, you have 5 plus 5, which is 10, and 2 more. So around 12 permutation and combinations that you could do. And every method will have its internal method and external method. So you can set prices through an internal cup, but you can test it through an external TNML. That's possible. So there could be such type of permutations that you can use while setting and testing prices. But remember one thing, you should not be way off in terms of justifying and documenting at the time of testing just because you are not set it right. So I would say both of these play very much in tandem. If it is pre and post, try to keep the method very similar. But these are broadly 2 approaches, and these are the 2 approaches that we use while setting and testing the transfer prices. Uh, a quick snapshot for you on the practical adoption. We also already discussed this. Now, quickly, let's look at the transaction. which are basically uh, we said for RPM and CPM for imports and exports. CUP is generally for loans, royalties, service fees, tangible transfers, and guarantee fees. And TNMM is used very widely for the other type of transaction itself. Okay. Other important concepts before we get into the practicalities is the arm's length range. Uh, Before to 2015, this arm's length range, the concept was not existing. It was the mean of various other comparable companies that was considered as an arm's length transaction or arm's length point. But then that changed to an arm's length range, which at a global level is called as an interquartile range between the 25th and 75th percentile. India has a narrower range than that, which talks of 35th to 65th percentile, right? So, and the arm's length margin exactly is considered as a median. So if you are going to be outside the range, then ideally any type of transfer pricing adjustment should be restricted to the median of it. And this is the range that is generally followed. PLIs typically are the ratios that we use to compare because there could be companies with different uh, I would say numbers and different sales and turnover numbers and cost numbers. So PLI generally acts as an equalizer for comparing those companies. Uh, and earlier there was only 1 year data that was used for comparability. But now you can use multiple year data. If for that particular year data is not available, you can rely on the earlier 2 years. So in general, you can use a 3 year margin, and there was a lot of litigation around this earlier, but that has come down nowadays. So typical choice of PLI is given here. I'm going to leave it for you to go through. Uh, yeah. And generally, the softwares used around TNMM, royalty searches, interest benchmarks are these softwares which are globally recognized. TNMM, to be very specific, Proves and Capitaline and HTP are one of the leading in India. Outside India, it is Capital IQ and Moody's BVD. BVD is more from European standpoint, and one source which is now Capital IQ is more US and North America region. That's where most of the TNMM happens. So these are the softwares. Again, for your information, is what I've kept here. Now, moving ahead, significant changes have been brought in because of the BEPS action plan. Out of the 15 action plan that were there on the international tax aspect of it, 4 action plans specifically spoke about transfer pricing, which is 8, 9, 10, and 13. Uh, there has been revision in terms of OECD guidelines in 2022, which incorporated 8, 9, and 10. Uh, and you are all aware of the new documentation requirement for master file and country by country reporting, which is your action plan 13, which changed the documentation requirement even from an India standpoint. Talking about documentation, as I said, three-tier documentation. You have the local file, which we call as a transfer pricing study report that continues. In addition to that, you also have master file, which is Form 3CE AA Part A and Part B. Part B is applicable where if your group turnover is more than 500 crores and your international transaction is more than 50 crores for tangible and 10 crores for intangible. And the contents of that are your organizational structure in general. This is something that you need to maintain in India if those conditions are met. Your description of global businesses, your intangibles that you own at a group level, your financial activities, your top 10 customers, and certain tax positions. So this is the master file which is made and maintained at a group level, and you also need to make and maintain that at the India level. Then you have a country by country reporting. This is a format given by OECD, adopted by India as is. So if your group turnover is more than the 6,400 crores INR, then this is something that you need to file in India. if your parent is in India, but if your parent is outside India, then you just need to inform for an automatic exchange of information to your government under a certain form that which country is maintaining this particular information. So this is a three-tiered documentation which is required by every constituent entity or a company to be maintained if they're qualifying for transfer pricing regulations. Now, quickly looking at the compliances in India, you have the Form 3CB, we have spoken about it. I have one slide for this also. Form 3CEAA is the master file, Part A and Part B. Form 3CEB is designation of it. Form 3CEAC is actually the CBCR, and 3CEAD is the information for the CBCR if it is maintained at a global level. Of course, there are other forms for Safe Harbor and APA, which are also forming a part of the forms for transfer pricing in specifics. Okay, talking a little bit about transfer pricing audit. There is no threshold for filing a 3CB, even if it is a 100 rupee transaction between two related parties or associated enterprises. There is a need that a 3CB is filed. A threshold is only for documentation under Rule 92D, and that currently is at and still is at 1 crore. The tax audit limits have gone up, but not the transfer pricing documentation threshold. That still stays at 1 crore of rupees. The documentation deadline is 31st of October, and the return filing deadline for multinationals covered by transfer pricing is 30th of November. Now, let's look at certain transactions which are of critical importance in transfer pricing. And if you see, I have divided these transactions into 3 rows. Now, if you observe closely, my first row is mainly talking of financing transactions. My second row is mainly talking of intangible transactions. And my third row is talking about service transactions. Now, essentially, if you look at profit shifting and base erosion measures, which I started my discussion with, these 3 transactions are at the top list where it can erode your basis or shift your profits without even a country knowing it, which means giving off loans and taking interest on those loans. It becomes so fluid. Your money is fluid. So any type of financing activities that you undertake will generally get into a high risk zone from a tax authority standpoint. So you have transactions of intragroup financing which can trigger the risk aspect of it. So if any of your clients have an intragroup financing, please watch out for it. Talk about uh, the reasons why loans are given, why equity is given, what type of remuneration on loans, etc., etc. Then the other classic transaction is outstanding receivable. Now, outstanding receivable per se is not a transaction, but when it is outstanding for certain number of days above the credit period, then it recharacterizes itself from being an outstanding receivable to a funding transaction. Let's take an example. If your parent company to a subsidiary company, the subsidiary company is basically providing certain type of services to the parent company where the credit period is 60 days. But if the credit is outstanding for more than, say, 120 days, then for the 60-day period, which is additional of it, it will be presumed as the subsidiary is funding the foreign company because the foreign company is not giving money to the Indian company or is delaying giving money to the Indian company. So that's a transaction of outstanding receivable. We'll discuss further in detail. Then you have corporate guarantees, where one company gives corporate guarantees to the other company for either getting the loan or getting beneficial interest treatments. Uh, then a lot of transactions around indenting and sourcing model. I know there has been a significant amount of litigation around the GST aspect of it, which will now reduce after 22nd of September. But even transfer pricing, the agency aspects have been one of the high risk areas from a litigation standpoint. Uh, from an IP perspective, any type of royalties that are undertaken and given needs to be closely looked into. Any type of R&D centers where India is getting paid for undertaking clinical researches. Uh, yeah, so that needs to be looked into very closely. Any type of marketing services, so you are a low risk distributor, but you are contributing significantly to the customer list or the customers or marketing aspect, which is the brand which is not held by you. So that is a marketing service, or that could be categorized as marketing service or building up of an intangible. And then you have cost contribution agreements, which are contribution for making a particular intellectual property, the results of which could be shared equally amongst the participants. Yeah. And the last column is on services. Now, services assume great importance again in terms of profit shifting, because any type of service that we are providing is going to be intangible in nature. Who is going to prove that that particular service has happened? Now, let's assume if our discussion right now is a service that I'm providing and I'm getting a crore against it, and I'm your associated enterprise. How would you generally prove that Akshay has come in here and he has spoken on certain things which made sense on transfer pricing, and because of that, we have paid him a crore of rupees? Now, that's only possible when somebody records it, documents it, and keeps it as a document under the transfer pricing documentation. Now, if by mistake you did not record this or you lose the recording, there is no proof of this particular transaction or service that has been provided for. Now, imagine such services which are provided at a global level by management or global management to a company management. That needs to be looked into very closely. Then you have back office services, contract manufacturing is something that we have discussed and covered. And you also have various other distribution services. It's not only the trading arrangements, but also the distribution arrangements, which has the element of service around it. Now, let's look at the first challenge around management or intra-group services. The OECD guidelines says that we need to prove, and the taxpayer needs to document it well, that services are indeed provided. That's just the example that I gave. The proof of those services needs to be preserved and needs to be provided to the tax authorities at the time of questioning. It's not only the proof, one also need to prove that why these services were indeed needed from the associated enterprise, why these services couldn't have been obtained, say, from an open market. What was the need of this service, and what has been the benefit that you have derived from this particular service? Now, to be very frank, not all services that any company gets can be showcased as it deriving any type of benefits, right? So it's difficult, but this is something that the OECD guidelines also prescribe for, and this is what the Indian income tax authorities have also been asking for over the years. Uh, Once we have proven that services are indeed rendered, next part is on allocation of certain costs and how a particular valuation is done with benchmarking. Your allocation could get into discussion around indirect and direct allocations. And there are various aspects of benchmarking, whether it is cost plus, whether it is profit sharing, whether it is low value added services. These are typically the topics that we discuss. And these are few challenges that we have encountered in the management service charge. Let's take an example where, from an India perspective, there is an outbound investment happening in the US. US typically is the center of getting things funded for, or for, I will not say head office, but a headquarter. It is getting funds from other US companies. The market is ultimately the UK, and you again have a back office in India, which acts on a cost plus basis. Now, ideally, a structure like this was not possible because this was almost considered as a round tripping before 22nd August 2022. Uh, But after the FEMA has given green signals around it, this has become a legitimate structure where money comes back to India in terms of cost plus, has a great opportunity for generating employment here, although the market jurisdiction could be something else. Now, if you see in this case, uh, one will need to also prove that why an outbound investment was made into US and why you couldn't have directly attracted funds to India, and whether the place of effective management is indeed in India. If it is proven that place of effective management is not US and US was just used as a vehicle to attract funds, then very well the US company could have an attraction back to India in terms of it becoming a resident in India. And this entire structure could collapse as US, India, UK structure without the funding part of US taking into consideration, right? Aspects like GAR, aspects like PE needs to be also looked into when you are building a transfer pricing model around, say, a back office service in this case. So the topic that we are discussing is management charge, service fees, but it has wider ramifications with other international tax topics also. This is just an example that I'm giving and the challenges that one could face in such type of a transaction. Let's look at another type of transaction where in one case there is a Dutch management, in another case it is Indian management. Uh, if say we it's an Indian subsidiary, it is paying to the Dutch management, all the conditions that I have told earlier from an OECD perspective, whether there is a cost benefit analysis, why these services were needed, whether there is actual proof of delivery of the service, all that needs to be documented for, and the payments, first of all, need to be proven for. Now, and if there is an Indian management with a Dutch subsidiary, one needs to be careful about the POEM aspects of it, along with the transfer pricing angle to it. So moving on with royalties and intellectual properties. Now, ideally, royalties are paid for use of IPs, right? Which means there needs to be an IP first in the place. If there is no IP, any type of royalty payments could be tagged as a tax avoidance scheme. So to the tax authority, India or anywhere else, you need to prove the existence of IP as step one. Now, when you prove that existence of IP, your IPs could either be your marketing IPs, which are brand, trademark, or it could be your commercial IPs, could be patents, it could be process flows, etc. Now, all of this, when you prove, uh, one needs to be one needs to document where the development, enhancement, uh, maintenance, protection, and exploitation of that a particular IP is happening. So very detailed guidance around this in OECD and OECD guidance in short. And all of this needs to be documented when you are proving payment of royalties from one country to another. Uh, there are various types of models of royalty. You can have royalty on sales or turnover. You can have royalties on a per sale unit. You can have royalties on the profitabilities. Any type of model is okay as far as you are able to benchmark it and it is within the purview of other independent contracts. Uh, yeah. So royalties is one of the toughest transactions to prove. Now, let's take this as an example. There is an Indian manufacturer in this case, and it is paying to UAE certain royalties for the processes that it is using. Yeah, and it is ultimately selling the amount to Japan, and Japan is ultimately the retail counterpart of India. And the Japanese companies are also paying royalties for trademark to the UAE free zone. Now, in these cases, let's assume there is zero tax in the UAE. One needs to prove the existence of IPs in the UAE. One needs to prove that UAE contributed to the DEMPE functions, which is development, enhancement, maintenance, protection, and exploitation. And UAE really need to prove the matter here to say that it has a full legal and in substance right to receive royalties from India and Japan. So it is transfer pricing in combination with GAR that generally is looked into while you are looking at transactions around royalties and IPs. Another set of transactions is intra-group financing. There has been detailed guidance on the group financing in 2022. It has specifically asked to accurately delineate the financial transactions, talk about debt separately, equity separate. Any type of substance needs to override the legal form in this case. As I said, again, financing is a very effective tool to shift profits, and this is a high risk aspect considered by any tax authorities. Uh, your contracts should be looked into. Your FAR should be very well defined. All those five circumstances and the characterization needs to be supported for. Uh, so yeah. So a lot of benchmarking around intra-group loans. In fact, one needs to prove why a particular loan is given and why not equity. Now, things like these are very important to be documented in a transfer pricing documentation itself, and not just jump onto an arm's length range in general. Let's take an example in this case. A US company typically borrows, say, US dollar 2 billion from the US commercial paper market, which is at 1.2% per annum, and lends this to India. India, in return, uses it for its purposes, but pays US at 10% per annum. Now, if you see, there is a clear profit shifting happening from India to US because the US is able to get things at 1.2%. So there is a significantly wide spread between what US has got it and how it has given to India. So the 10% per annum rate needs to be proven for, but most important is to prove the lending facility of 2.4 billion from US to India itself. That's a credit facility. Yeah. Another financial transaction is and could be the corporate guarantees. Now, say uh, the Indian company wanted certain type of loan, its rating was BBB plus. It could have got the loan only when the UK company would have given certain type of guarantees to the banks or to the public at large. By giving this particular guarantee, my rating improved to AAA. And there has been a payment of guarantee commission at 1% from India to UK for that. Ideally, such type of transactions are okay to have if you're able to prove the benefit around it and ultimately benchmark this 1% with the independent transaction and also document it well in detail in your transfer pricing documentation. A s- Generally, a question is asked by the tax authorities whether such type of an activity is a shareholder activity. That depends on the facts of the case. Uh, Now, in this case, if you see the facts where my rating was earlier triple B plus, but because there has been a guarantee given by the UK company, my rating improved to triple A, and I was able to save on certain interest. So this doesn't become a shareholder activity because it is not in the capacity of shareholder that I have given a guarantee. It was an independent commercial transaction in itself. Another aspect we discuss is on outstanding receivables. I've already explained you the concept. But generally, the best way to address this is every time it's not possible for your AEs to pay you in the credit period, and maybe because of that, you may have to take certain positions in your transfer pricing study report. You can take positions like the taxpayer has been a debt-free entity. You can take positions like your payables are not asking for any type of interest from you. Then why should you be paying interest on certain receivables? You can look at net of receivables and payables and show that particular position to your associated enterprises. Yeah, and ultimately, if there is any type of receivables outstanding, then ideally the law says that the interest rate should be the foreign interest rate if the transaction is undertaken in the foreign currency. So uh, please take care of receivables and outstanding receivables if you are entering into related party transactions or associated enterprise transactions. Now, I want to leave a last 10 minutes for any type of questions that we have. Uh, but few slides are regarding challenges, because addressing any type of audits and assessments itself is a challenge in transfer pricing. So most important is to build in a particular discipline in your transfer pricing documentation. Make your client aware, your entire client business team aware of the internal processes that they have. Maintain contemporaneous documentation, and documentation should not be really a dry documentation. It should tell a story of transfer pricing. It should tell a story of how you want to do business today and tomorrow, and how you have been doing business. Uh, Talk to a transfer pricing expert much earlier, so that you are not caught by surprise by the tax authorities. Maintain that tax and fiscal discipline with your clients, and if you are a client, within yourself. Now, few steps for TP adoption. Uh, Transfer pricing is not a very different subject than business. Try and align transfer pricing with all your business strategies. If there are some different strategies that is impacting the price in general, please document them and showcase to the tax authorities whenever they ask for it. They might understand. If they don't, then the higher ups will understand. Engage all the stakeholders. Don't just discuss it with a tax head and a tax manager. Uh, Build a transaction map for all the transactions that you do at a group level. Don't only look at one company in general, look at entire group and see what type of transactions that group is entering into. Also identify any type of tax leakages. Tax leakages means taxes that you are overpaying, which ideally you shouldn't be. Uh, Select definitely the right transfer pricing method, which is relevant to your particular transaction. Uh, Transfer pricing is all about managing risk. It is managing risk at both sides, because there are two countries involved. It is managing risk with the tax authorities. It is managing risk with the board. So it's a tightrope walking. Be compliant in that area and always take guidance around things. Now, there has been a significant amount of discussion around whether you should just outsource your transfer price, or whether the company should also take equal interest in transfer price. I would say the right answer is achieving the balance between both. Uh, do seek guidance externally, because generally the external consultants are aware of what's happening in and outside the tax authorities areas, and what type of stance they are taking. But also develop an internal resource or a team which has a view on transfer price and which can guide the business around it. So you need to achieve a balance in general, and this is mainly for multinationals that is important for. Uh, Few opportunities in transfer pricing outside the challenges is the business is growing. A lot of cross-border opportunities are opening up. Uh, Countries like UAE has now a detailed transfer pricing regulation, which 5 years back nobody would have thought about it. So, from a professional standpoint, your opportunity goes much higher. Unlike a tax law, transfer pricing has common acceptances at a global level, and everybody believes in documentation and the same story. Uh, OECD guidance, be very close to it. Uh, that is where most of the companies are focusing on, and keep yourself updated on those sites. Automation, AI are other opportunities in transfer pricing. And if you see globally, things are shifting. Things are shifting from earlier just the legal basis of tax and TP to more robust, transparent basis of taxes. There are things like tax disclosure forms, and there are things like tax compliance reports that bigger listed companies are releasing to showcase their positions around taxes to the investors and public at large. So the opportunities in global transfer pricing arena is growing very significantly. You have things like APA, safe harbor, value chain transformations, supply chain optimization, ultimately automation that is becoming very relevant. And the Indian transfer pricing professional is going to play a very important role in all of this overall. Yeah. In addition to that, litigation support is essential. Taking the right positions before the tax authorities is essential. Uh, Setting up of SSCs, which is shared service centers in India, has been on the rise in transfer pricing. So hiring around that arena will go up. And most important is uh, Indian professionals can act and also write articles at a global level, showcase their talent and thought leadership around it. So these are few opportunities which I thought are essential and should form a part of the presentation that we are doing. From a future perspective, these are few things I think where overall taxes and TP will move. There will be significant amount of automation which will be required. So only value-added aspects of transfer pricing will be considered. Um the resources are few in transfer pricing, so well, which means that professionally the value of transfer pricing expert will be high. Everywhere, the compliances are on the rise, and which also means that professionals have more and more opportunities around it. Globally, things are becoming transparent. Nobody can hide their money under the bed these days. If you are a multinational company, they have to be very transparent. APAs are gaining popularity in India itself. I think more than 900 APAs have been concluded. Uh, Disputes are on the rise because there has been questioning the economic conditions of a country are improving. So there will be a lot of dispute resolutions to be undertaken. Documentation need at a global level will go up. Uh, Everywhere, even at the board level, nowadays, I get this a lot that they want uh, the transaction between two companies to be at arm's length. So it has become a discussion of board now, and it's not only restricted to a tax head. So that's going to be the future of TP. Everything is what companies would want to consider and enter into arm's length price in itself. I think we okay. Now I think this is it. These are key takeaways of today's discussion. I will not repeat any of those, but I'm leaving this for uh, your benefit. Any questions? I'm more than happy to take now. If not, we can conclude on the session. Thank you.
Good evening, everyone. Uh, I am requesting the host to please turn off my video because I think it has been off. Thank you so much. Good evening, everyone. So, first of all, I would like to thank Akshay sir for this phenomenal presentation on transfer pricing aspects, where he covered the compliance, litigation, as well as the advisory aspects. So, sir started from the history part and then he covered the adjustments parts really pretty well. And he explained the CBC reporting also really good. So, first of all, I would like to thank all the lovely audience present here because yesterday only we completed our income tax returns and it was really good that all of them showed up for this session. So, first of all, I would like to thank the audience. Second, I would like to thank our chairman, CA Ketan Sahiya sir. And then I would like to thank WRC ICI for this this wonderful seminar. Thanks a lot again.
Yeah, thank you all.
Well, thank you so much for your valuable time, and it was a wonderful session.
Thank you, Ketan bhai. Just that I have to run it very quickly. I would have loved to get into more and more details. But sometimes 2 hours is too short a time for explaining entire thing in transfer pricing.
True.
But maybe for another time.
Anyway, we enjoyed, and I'm sure the participant also would have enjoyed.
So thank you.
Thank you.
Okay.
Thank you, Tanvi.
Thank you.
Thank you, Chintan.
Thank you, sir. Thank
Thank
you
you,
so
sir.
much. Thank you for the opportunity.
Thank you, sir.
Thank you. Bye-bye.